guys, it is July the 7th. It's amazing how intense this market has been to start off the month, that it's literally only been 7 days plus a holiday. It feels like it's already middle of the month, but that's probably because we are going to most likely go into this period that feels a little bit different, is my guess. And what I mean by that is that we've been in like kind of this crazy quiet in between period. There's a ton of uncertainty, and then we're going to have a series of earnings reports that are going to come out, and that really, I can see people already moving their head to that space. And I think that's what the rally's about. Okay, we got to always say past performance not indicative of future returns. This is what the market looks like today. Huge recovery, particularly in NASDAQ. The Russell's also recovering in small cap world, and crude has finally inched back over 100, as have most raw materials. How do we think about that? Here's what I think is actually happening. Okay, you know, all along, crypto is not the thing that I usually talk about, but I got to tell you, like, I've been reading up aggressively, so I may actually start trying to help the world a little bit, disseminate Web3 and things of that nature going forward. But this thing to note is not that crypto affects equities, even though they seem very highly correlated. What do I mean by that? It turns out that a lot of times when we have a red market, we also have a red crypto market, and vice versa. And it really has to do with the mechanics of how markets work. Sometimes if fund XYZ is unwinding and everything they own is growth oriented, and they might have some crypto in it as well, it's going to just naturally create, it's not quite a contagion. It's more like you got a margin call here, you got to come up with cash. If you really wanted to hold Bitcoin and Ethereum for the long term, because it's a real pain in the, backside, plus, and this is kind of important, you got a higher commission to trade your crypto versus trading something else, then that can lead to a certain type of behavior in the equity markets in particular. Because, and I've mentioned this before, a lot of people think about liquidity risk as if it's only one direction. Sometimes things that are very liquid also take it on the chin in a very different way. And this is a dynamic that all us old timers, Dave, who's always hanging out with me and making hopefully some fun comments to make sure I stay straight on track. But if you've been in this market for any amount of time, illiquidity risk or premium, and liquidity risk and premium, they're a real thing. Sometimes the market bids you up because you're highly liquid. Sometimes the market bids you up because you're not liquid at all. And so there's a little bit of that that's going on. When you have something like Voyager Digital filing for bankruptcy, or really any of the cryptos, Luna, et cetera, come out, you have to realize that they were holding something as collateral. And that something that they're holding as collateral is the thing that had to get sold. In a lot of cases, the things they held were just other cryptos or other NFTs, and so nothing got sold, but someone took a hit and may have been using that as collateral. And then this chain of events happens all the way through, and that's how you end up with a highly liquid equities market potentially getting beaten up as well. So my suspicion is that any bankruptcy within the crypto space does have impact for a certain particular part of the market. Now, why in the world energy and oil would decline, I have no idea, but just realize that there are two types of ways that you are able to determine who gets there. Like crypto runs on energy in a couple of different, very unique facets that I'm now learning hardcore within the space that I think a lot of other people did not fully understand, but it really does bode a particular way for nat gas, even above and beyond all the conflicts that we're experiencing. But we'll kind of get into that a little bit in a bit. The market rallying back up, in my opinion, is because it is hella dangerous to be short or long in front of the financials, which will report first, and then immediately after you get the start of energy reporting. Again, I have mentioned more than once, it's all finance starting the 14th, and then immediately you get the pipes and you get the oil equipment companies reporting first, followed almost immediately by just a couple of refiners reporting, not all of them. And then it's really in August when you get your oil, your E&P guys, your exploration production, and also your onshore guys reporting, so that you can get a very clear picture. as far as utilities goes, the rally in utilities to me is kind of dumb. I'm just going to tell you now because like I am not a fan of running into utilities as a defense mechanism. If you want to do it as a day trade, knock yourself out. But largely speaking, it is a dangerous place to be in utilities. So if that's what you're going to do right now, be very careful. You want to look for yield right now in general to balance out your portfolio, yield that is not at risk. And so I am going to go really briefly through what we're seeing there. And again, there's not really much this week. The jobs numbers came out that didn't cause any kind of meaningful grief to the marketplace. I'll have a little bit more on that tomorrow as well. The foreign trade balance, people aren't really doing much with this. I really think that everybody's just prepping up for next week so they can be neutral and take money off the table. But since this market has been so crowded short, it's really dangerous to continue to do so for a number of names. Now, there are a number of names that are just going to prove out that they really deserve to be puked out. And it's a real question mark whether the market will continue to short them or whether you'll get a dead cat bounce followed by a bunch of shorts. So I think this earnings season, more than any other earnings season, will be very dangerous to play. But it bodes well for the options folks because it means there's going to be a crazy amount of volatility. All right. The one name that I do think got puked out a little too aggressively that I'm going to go through today, and I just want to talk about it. You will want to find spots to buy it, and that is IEP. This is one that in general, David, on your side on the technicals from time to time, you've been bullish on, but also you have screamed at the top of your lungs, this is an awesome stock. This stock is Icahn Enterprises, Carl Icahn's private equity fund, essentially, is what this is. And you can go onto their investor website and see precisely what it is. But you had asked me in the middle of earnings season May, can you please find a way to take time to look at this? And I looked at it, and then I thought about it, then I looked at it again, then I thought about it, and then I watched Carl Icahn's documentary on a plane, and I was like, this is a sign for me to take another look at it, so I did. This has an $8 dividend yield, 16% dividend yield, 16 and a half, $8 is what it gives you on the forward dividend. I think that's because this is not correctly updated, but this is a huge dividend yield. I don't think it's $8 because it's somehow reading 16%, but it's a gigantic dividend yield. And I am fairly sure that I can demonstrate that there is no risk to this dividend. And if anything, this is probably one of the cheapest ways to get exposure to a refiner right now. And again, why are the refiners doing so well? They're doing really well because there's no refining capacity available because Europe has issues right now, for lack of a better way to do it. But this is US refining. And even in US refining, we do have capacity issues going on as we speak. And so to me, if for no other reason, you should own Icahn for that. But let me show you what he actually published in his May 9th earnings quarter report, just to demonstrate. This is the way you read this is the revenues that were generated, and you can kind of see, this is net asset value, okay? And I'm gonna go through net asset value, and you can see CVR Energy is the refining business, and it went from last year, 1366 to 1818. This is 100% a function of the capital improvements that were made, plus the fact that refining margins have just like completely been awesome sauce. And there's reasons for that, which I've discussed over and over again in these calls. This is the bulk. This is like, okay, so if you look, total assets here. Okay, so that's 1.8, and then you just got to sum up everything else, but it's almost a third of the net asset value. Okay, and then the other part of it is this Icahn Auto Group. It's gone from 1.5 to 2.6. Now they did acquire some assets in between here to get that to 2.6. But what this business is basically auto parts and servicing. Auto parts and servicing. Okay, why do we like auto parts and servicing right now? Let's be really clear. We like auto parts and servicing because cars are getting older. Why are cars getting older? Cars are getting older because we have an import issue, and also people can't make the cars right now because the semiconductor shortage is still real. As much as people want to pretend like, oh, Micron, so semis are now inventories higher. Guess what? Micron said that, and they said, guess what? We're going to manage inventory like hawk, and so is everybody else in this industry. So they're not going to leak out semiconductors in this stupid way. They still have backlog, but the fact is we lost a year of buying within the autos industry. So cars are older, and that is what it is. That's why there should be no risk to being able to pay the dividend. Now, the other thing you should look at always is cash flow. The presentation that he did present gives you net income numbers, which you can see net income numbers doubled from last year to this year on the quarter, mostly coming from what? Energy. Okay. Also the investment portfolio as well, which consists of one big gigantic energy company, and also really boring stuff like Bausch. Okay. Like boring reoccurring healthcare cash flow. So this should be fine as well. And the holding company has a minor loss that's decreasing. This food packaging, by the way, if you're concerned there, that is basically sausage casing. Okay, that's what it is. So sausage casing will probably do just fine, because let's call it what it is. You're going to start eating hot dogs if protein gets more expensive. So this is probably a very limited risk to this. That's why 13, no change, even with food inflation. Okay, turns out sausage does well in all environments. And I mean, generally speaking, this is a pretty safe circumstance. And if refining margins continue to do well, it's just going to generate a ton of cash for the next couple of quarters, to give chance for this pharma company, which is basically a bunch of there's like one thing going through phase 3, probably going to make it through, and then a bunch of cash flowing stuff that is doing just fine. So there should be no risk to the dividend this quarter at all. Hence, if we're looking for a back half of the year where I'm worried about kitchen sinking happening across the board, what is kitchen sinking? Again, that is a company that has basically not performed in the first half of the year, deciding that it's not worth it to perform for the rest of the year, and would rather just do a bunch of accounting stuff, which is the right call if you're a CFO, to set yourself up for equity valuation improvement for next year. That's what I would do if someone was like, May, come in and bank this thing. That's probably what I would do. Sorry for anyone who finds that offensive, but that is what it is. But IEP, I think, especially since it's gotten clobbered. Here, let me just show you this chart really quick. Today it's up a lot. So maybe today up 1%. I mean, it's less than the market isn't today. You probably can, as this market plays around, just try to accumulate down in here. But there shouldn't be any risk to this stock, and there shouldn't be a 16% dividend yield on this bad boy because there's no risk to the dividend. Actually, I think that given where rates are at right now and what's been happening, you're still going to have the same problems that we had the front half of the year, which is, how do I find safe yield? Right? Like if you're a pension fund, you need something that safely yields you something, in order to pay off the liabilities that are embedded in any pension fund. This to me looks pretty safe. I feel comfortable suggesting this. And then the strategy that we've been suggesting all along with this one is buy puts when the stock, because in general, this as a equity, it's still structured as an equity, does have volatility risk in it in a crazy market. And with that, let me hit pause, and then I can take questions, and we don't have to make this the longest day. Any questions?
Hey man, yeah, I like hot dogs.
I do too. Are you making fun?
Anyway, yeah, IEP, we bought it just for the dividend. I mean,
Yeah,
$8,
That's really good.
$8 on a $50 stock is 16%.
Yeah.
Okay, double 8.
Yeah. Sorry. Look, I think it's a great situation for investors to consider, right? Like, and when things are like this and there's no risk to the dividend, and you're worried about the end of the year, like the natural, the risk-free rate of the return is the risk-free rate of the return, and then there's the equity risk premium. The dividend alone more than covers that hurdle. So I think here, crushed as badly as it has been with everything else that's been thrown out with the bathwater, this is not everything else. This is still Carl Icahn. Okay, you know what I'm saying?
Well, I mean, it's gone from 52 to 49, and it's not really crushing it. But
no, at one point I think it was as high as 55. That's why I'm saying it that way.
Oh, okay.
Yeah. Uh,
Yeah, well, thank you for looking at,
yeah,
so,
at one point it was as
um,
high at 55 and change, and now it's 10%. You're getting a 10% discount off of that, off a stock that has a dividend that really it shouldn't have. Do you know? I mean, a 60% dividend yield usually indicates that there's something wrong with the
right,
underlying assets in some way. You and I both know that. Just for the viewers, there is nothing. So then any fundamental person should go in and review what's going on with the underlying assets. The underlying assets are cool. There's nothing wrong with them whatsoever. They'll continue to cash flow generate. So all that's really going to happen is he's going to give money back to investors, or maybe he buys something in this crazy time.
yeah,
Yeah.
the difference between Carl Icahn and Warren Buffett is Icahn gives it back to investors and Buffett reinvests it.
Yeah.
There's nothing wrong with either one of them.
What's that?
There's nothing wrong with either of those styles.
Yeah, agreed. And also in these like times when the market is really scary, if you're a long-term investor, these are guys that you want to, have exposure to in general. And now you're getting exposure to them in ways that are really beautiful. The other thing that I was absolutely buying is Berkshire Hathaway, and I tend to buy my options out a bit, and I'll buy them as a call spread, trying to recreate it over 300. Because Warren has been very clear he'll buy it at 280. That's how he ended up accumulating a bunch of Berkshire Hathaway shares from January to February of this year. So he thinks his stock is undervalued anywhere under 280, but he's got a really smart trader at the trading desk. So it means that it can be under 280 for a bit of time. But yeah, Berkshire Hathaway is fine here too. It's just that Berkshire, and I think I mentioned that maybe last week when it was trending down below 280. Today with the market up, I do think that like next week on financials, you want to be hedged. I'm going to watch JP Morgan, but I will short JP Morgan if it gets too ahead of itself. And then I will look to probably take short exposure in financials going into earnings season next week, because here's the thing. I love Goldman Sachs, as you guys know. Under 1x book, that thing is cheap. Every day of the week, I will say that. The investment banking revenues are going to be crap. The yield curve is flattened, and they really just have to wait for the market to settle down and a little bit more just news to happen for them to really appreciate fully how to play the next couple quarters. So if anything, I would imagine it's not so much that any of them are going to report losses or anything negative. It's just that they grew so aggressively out of COVID. I'm not sure how the market will react to whatever they have to say. With JP Morgan, though, I do actually think JP Morgan is playing this game a little strangely. As much as you don't like Jamie Dimon, I admire the man. And so I can appreciate why you don't like him given his behavior in 2008. That's totally fair. But I do think he's playing a very strange game in this marketplace of what's happening in banking. So I'm not a huge fan of JP Morgan, and I personally don't believe they deserve the premium that they continue to get. Sorry, JP Morgan fans. I think that there are better banks out there to be a part of and alongside, but it's hard to say. Everybody loves being long JP Morgan.
Well, it goes down every day.
I know. Well, there's that. I know. I wish I would have been more aggressive on my shorting of JP Morgan when they reported last year. But yeah. I mean, JP Morgan, like, I got to take another look. But all of them are going to have a rough go of it in the back half of this year. What they really need is some kind of stability in the marketplace to indicate how the banking revenues are going to pick up. And the volatility of this market, even though there are great opportunities, typically scares off the retail investor from doing too much. That's part of the reason why I wouldn't recommend it necessarily, because you got to be careful on the day and it's so damn volatile. But I've been known to buy puts on Robinhood. And even though I've been hella bullish on Schwab most of the year, I stopped being bullish last quarter and am a little bit nervous about Schwab's quarter as well, because the retail investor will capitulate before the institutional investor will. So in general on the financials, I'm very worried. I'm not making a call because like literally it's going to be binary. And then on top of it being binary, who knows what the market will actually do. So there's that.
Okay, great.
I don't know. It's going to be a fun time, David, I think. Let's see how it goes. All right,
Okay.
guys. See you tomorrow. Take care.